Okay, welcome to our today's lesson. We want to look at how to calculate income that involves commission. And maybe just a reminder, in our previous lesson we had started looking at how to calculate income. We looked at how we can calculate income involving overtime, and we went as far as looking at how to calculate income involving shifts, where the rates of payment did vary from one shift to another, where we had the morning shift, the afternoon shift, and the night shift. In this particular lesson, we want to deal with income that involves commission. As we had defined earlier, commission is basically payment in form of a percentage of the total sales that a person has made. So we can define commission as commission is a payment in form of a percentage of the total sales. That is, commission is the payment in form of a percentage of the total sales that a person can make. So if we take our commission to be something like X, we can end up saying that commission will be equal to, is basically a percentage of the total sales. Of the total sales. So this basically will be X out of 100 of the total sales. Is a percentage of the total sales, where X is the commission, where X is the commission. So having defined this term commission, I would want us now to move on and look at examples so that we can internalize this particular concept. And our first example Jeff sells membership to a gym, and he receives $225 per week plus a 5.5% commission on his sales. So we are supposed to calculate his gross income after a 5-day week. We are supposed to calculate his gross income after a 5 days We will use this particular table to answer that particular question. So we have the first day, the second day, the third day, the fourth day, and the fifth day. In the first day, his sales were $680. Second day, $450. $925. $1,200 on the fourth day, and on the fifth day, the sales were $1,375. And also a reminder that we ought to know what this particular term gross income means. Gross income, we have already covered this in our previous lesson. This is basically the income before deductions have been effected. Before we do any deductions on the income, that is what we refer to as gross income. So as you can realize is that when we are going to calculate this particular gross income, it will entail two parts. The first part is where we have the $225, that is the base payment or the base salary, which means that even if he makes sales or not, at the end of that particular period, he has to earn $225. And there is a second part where we have the commission being effected. So we are going to look at those two and how they will help us to get the gross payment, the gross income to this person called Jeff. So gross income will be equal to the base salary plus the commission. Plus the commission. And remember the definition of the term commission, which is basically a percentage of the total sales that will have been made in that particular period. For us to get the commission, we need to get the total sales. These total sales will be obtained after adding all the sales throughout the week. This will be equal to $680 plus $450. Then we add on $925, $1,200, and lastly $1,375. This will give us a total of $4,630. These are the total sales. So our commission, we are going to calculate the commission based on this particular total sales. And the commission, which is equal to 5.5% of the total sales, and in this case our total sales are $4,630. So for us to calculate the commission, we need to convert this particular percentage into a fraction or a decimal so that we can multiply with this particular total sales that we have. This will be the same as 5.5 out of 100 multiplied by $4,630. And this will give us a commission of $254.65. That is the commission that we are having. So we are going to use this as our commission, and we have our base payment or base salary. So this gross income will be the sum of the base salary, which is $225, plus the commission that we have just calculated from the total sales, which is 254.65, and this will give us a gross income of $479.65. This will be Jeff's gross income in that week. Let us move on and look at a second example. Example number 2. A real estate agent receives a 2.75% commission on the sales of a house. Valued at $125,000. Find the commission earned. Find the commission earned. Find the commission earned. And the commission, we've been told, is actually at 2.75% of the total sales. And the total sales is the value of this particular house. This house is valued at $125,000. This means our commission, from our definition, will be equal to 2.75% of the total sales, and this will be 2.75 out of 100 of the total sales, which is $125,000, and this will be actually equal to $3,437.50. This is the commission to the real estate agent. This is what the real estate agent will make after selling this particular house at $125,000. Our third example, a car salesman earns $500 a month plus 3.5% commission on all sales. On all sales. In the month of January, in the month of January, he sells a total of his sales total to $56,000. His total sales were $56,000. And our first question is for us to calculate his commission for the month of January. Calculate his commission for January. They are not asking us to calculate the gross income, but they want us to calculate just the commission for the month of January. And as we have learned that commission, it is good that you write down the guiding rule or the guiding principle that will help you to get what you are looking for. Commission is a percentage, and in this particular case is 3.5% of the total sales in that particular month, and the total sales were $56,000. So this commission will be 3.5. We express this percentage as a fraction or a decimal before we multiply with the total sales. This will be 3.5 out of 100 multiplied by $56,000. This commission will be $1,960. This is the commission for the salesman. The second question is we need to calculate his gross income for January. And this gross income basically will entail the base salary plus the commission. Gross income is the sum of the base salary and the commission. Always remember that this base salary is the income to the salesperson, whether he or she is going to make sales or not. He must or she must earn this. And the base salary, in this particular case, we were told that the base salary is $500, whereas we have calculated the commission as $1,960. This will give us a sum of $2,460. And as I had told you in our previous lesson, that the commissions are there to encourage the salespeople to be aggressive, to go out and do more sales, so that they can earn something more. The more you sell, the more your income increases. So let us look at one last example, that is example number 4. Portia earns an annual salary Portia earns an annual salary of $27,000 plus 2% commission on all sales. The questions are, we find A, her weekly base salary before sales. Find her weekly base salary before sales. We have several questions, around 4 questions. This is just but the first one. So I want us to deal with each question. We get the question and we solve it before we move on to the next one. Remember, we have already talked about the base salary, the income that this particular lady will get whether she makes the sales or not. And her annual base salary is at $27,000. And here we want to get the base salary for a week. So this $27,000 is equivalent to 52 weeks. So 52 weeks annually is equivalent to a base salary of $27,000. How much will this particular lady earn as the base salary in a week? 1 week will be equal to one week multiplied by the annual base salary, which is $27,000, divided by the number of weeks in a year, which is 52 weeks. This week and week will cancel. So if we divide $27,000 by 52, we are going to get $519.23. This figure has been rounded off to 2 decimal places. Her annual base salary will be $519.23. Let us look at the next question. The second question is, we find her commission for a week where her sales totaled to find her commission for a week where her sales totaled to $7,500. We want to calculate the commission. The first question wanted us to calculate her base weekly salary. Now we want to get the weekly commission. The commission that she will make in a week where the total sales were $7,500. And we have learned that commission is basically a percentage of the total sales. This time round, we've been given the commission is 2% of the total sales. And the total sales in this week is $7,500. So this commission will be 2 out of 100 multiplied by $7,500, giving us $150. That is the commission that Portia will make in a week. Having looked at this, let us move on and look at the third question and see what it requires us to do. Part C, they want us to find her gross weekly income. Find her gross weekly income for the week mentioned in Part B above. For the week mentioned in Part B above. In this particular week, they want us to find the gross income, which is the income before deductions are effected, and the gross income will contain the base salary in that week plus the commission. Of course, this particular commission will be in that week also. We have calculated the base weekly salary, and we have also calculated the commission in that week mentioned in B. So this will basically be addition. The base weekly salary, we got, it was $519.23. I hope you remember that. And the commission is $150. When we sum, we are going to get $669.23. This is her gross income in that particular week. And lastly, our last question. We are required to find her annual gross income if over the year her sales totaled to an amount to the tune of $571,250. Those are her total sales in that particular year. Remember, we have already calculated her commission, weekly commission, her weekly base salary. And now this last question wants us to have to calculate her gross income annually in a full year, having been given the total sales as $571,250. Gross annual income will be the sum of the base annual salary plus the annual commission. The annual commission. And her base annual salary we were already given. This is equal to $27,000. Her annual commission is basically 2% of the total sales, total annual sales, which is $571,250. So this will give us so the commission will be 11,000. Her annual commission will be $11,425, and this will give us a total of this is what she will earn. She will earn a gross income of $38,425 in that particular year. Having looked at that, I want us now to move on and look at something else, something new, because we know that in the course of working, it reaches a time where someone decides to take an off or to go on holiday, to take a break from work. And this person will still be paid. We want to see how the payments will be effected in case the person is on holiday. Will he or she earn more or less? That is what we want to look at. And this is what is referred to as calculating the holiday pay. How do we calculate the holiday pay? When someone is on holiday, this person still earns a salary. Whether a person was earning a wage, that is a income calculated on daily basis, or a salary weekly, that is weekly, in 2 weeks time, or monthly, this person is paid when he is in holiday. And this is actually referred to as leave loading. So we can start by saying some wages some wage and salary earners are paid what we call leave loading. Leave loading. This is basically the payment, mode of payment when one is on holiday. When one is on holiday, and this leave loading actually brings in a change in your normal pay because it is something more. So when what I'm trying to say is that when one is on holiday, this person will earn the normal pay plus a bonus. plus a bonus. The normal pay plus a bonus, and this is what is called leave loading. This is usually 17%. Leave loading is usually 17.5% of the normal pay. 17.5% of the normal pay. So this is what is added on the normal pay. So it is some kind of, we are increasing the normal pay by a certain percentage. And remember, in our previous lessons, we have already looked at how we can increase a given amount by a given percentage. You need to revisit that particular concept so that it will help us to solve questions arising from this particular subtopic. For example, let's look at how do we carry out these calculations. James earns a normal pay of $1,500 in a week. Calculate his holiday pay. We need to calculate his holiday pay, and also we need also to calculate leave loading. That bonus that he will, leave loading basically refers to the bonus that he will earn. For us to get his holiday pay, we increase his normal pay by 17.5% to get what he will earn. Increasing that normal pay by that particular percentage. So it means the normal pay in this particular case, we take it to be 100%. So the holiday pay will be the new percentage, the higher percentage. So this holiday pay will basically mean will be the normal pay, which is taken to be 100% multiplied by the new percentage, which is 100% plus 17.5%. This will give us the holiday pay. And the normal pay in this particular case, we are told, is $1,500. The new percentage will be 117.5%. And for us to multiply with this particular figure here, we need to convert this. I hope you remember that particular concept. You convert this new percentage to a fraction or a decimal before you multiply. So this will be $1,500 multiplied by out of 100, and this will give us a holiday pay of $1,762.50. This will be James's holiday pay. He's earning much more, and yet he's not working. He's on holiday. So we move on and look at the second question. How do we calculate the leave loading? Leave loading, we said, is a bonus. And how do we get this particular bonus? It is basically the difference between the holiday pay and the normal pay. That difference is what we are calling the bonus. And that bonus is given a special term, which is actually referred to as the leave loading. So our leave loading will be equal to the difference between the holiday pay minus the normal pay. And our holiday pay we have calculated is 1,762.50, and the normal pay is $1,500. This will give us a leave loading of $262.50. This is the bonus that James will earn. So maybe to summarize this before we move on to the next example in form of a chart or a diagram. We have the normal. We have the normal pay. James's normal pay is $1,500. And for us to get the holiday pay, which is $1,762.50, we need to take this particular route. How do we achieve these results here, as indicated by the arrows? This means we need to have a new percentage. We effect a new percentage. This is 100% plus 17.5%, giving us 117.5%. This is what we use. And this will give us a factor of 1.175. This is the factor from this particular percentage. This factor is what we multiply by the normal pay to get the holiday pay. And if at all you are given the holiday pay and you want to get the normal pay, how do you do that? You divide the holiday pay by the same factor. You divide the holiday pay by 1.175 to achieve the normal pay, to get the normal pay. And lastly, we can say that for us to get the leave loading is actually 17 0.5% of the normal pay. We can calculate leave loading by getting the difference between the holiday pay and the normal pay, or we can go ahead straight and look at 17% of the normal pay. That will give us the leave loading. That is another way of calculating that. So let us move on and look at another example. Rachel's normal pay is $1,200 per week. When she is on holiday. When she is on holiday. When she is on holiday, she is paid (17.5% per year leave loading. The first question is, how much is her holiday pay for a week, for 1 week? How much does she earn while on holiday in 1 week? And normally she is paid $1,200 per week. So her holiday pay is actually 100% plus 17.5% of the normal pay. The normal pay is increased by 17.5%. This will give us (117.5% multiplied by the normal pay, which is $1,200, and this will be expressed as a fraction before we multiply by the normal pay, giving us a normal pay of $1,410. This is her holiday pay. The second question is, how much is her leave loading for 1 week? How much is her leave loading in 1 week? We have said in our first example that her leave loading is basically the difference between the holiday pay and the normal pay. which will be 1410 minus 1200. This will give us $210. This difference will give us a leave loading of $210. And remember, this is just one of the ways in which we can calculate the leave loading. Alternatively, this leave loading is equal to 17.5% of the normal pay. This will be 17.5 out of 100 multiplied by the normal pay, which is $1,200, and this will give us $210. So we have two ways in which we can calculate the leave loading. The first way is finding the difference between the holiday pay and the normal pay, and also the second method is whereby you find 17.5% of the normal pay. Let us look at our last example. This example is a bit different from the first two. Mel is taking her holiday. She receives $2,937.50. This includes her normal pay and leave loading. This includes her normal pay and leave loading. The question is how much was the leave loading? How much was the leave loading? So this amount, we take it to be, and it is actually the holiday pay. The holiday pay is $2,937.50. This is equivalent to the normal pay that we said is taken to be 100% plus the leave loading, which is 17% of the normal pay. So this will mean this 2,937.5 is 117.5% of the normal pay. And remember, the leave loading is basically 17.5. So if 100 and 17.5% is equal to 2,937.50, then 17%, then the leave loading, which is actually equal to 17.5%, will be equal to which amount? This will be equal to 17.5% out of the 117.5% multiplied by the holiday pay. Multiplied by the holiday pay, which I'll write here, which is 2,937.50. And if we do that, we will find our leave loading as $437.50. That is the first way in which you can calculate this. You can also go ahead and calculate the normal pay, which is 100%, so that you can find the difference between the holiday pay and the normal pay, which will give you the same figure. Having looked at those three examples, I hope that you have understood the concept, and I'm looking forward to meet you in my next lesson, where I'll be looking at another concept. I hope you have enjoyed, and thank you.